What's up, guys, and welcome back to the channel. Nick here. And this week was pretty crazy. As you can see, I started the week at almost $46,000, but I ended with a current value under $45,000 again. I have $44,512.68 for a market loss of $1,612.41 and only $4.36 in earned dividends. So let's just review my portfolio. In this past week, I only had three stocks in the positive: Kellogg's, Hormel Foods, and Verizon, which was 23 cents, so not much. And I got down as much as 9% from Altria Group and 8.44% from Texas Instruments. However, at the same time, I can show you guys my dividend growth chart, and you can see that my dividends are increasing year over year, and we're not even halfway through 2022, and I've already earned $1,000 in dividends, which, as you can see, in 2021 I earned $1,400 after 12 months. So I definitely believe that I can hit $2,000 a month, or $2,000 for the year of 2022, and I'm really hoping to hit my goal of an average of $200 a month in dividend income. And now let's actually look at the activity for the past week. On June 6th, I earned an $18.03 dividend from JEPI, as well as $15.54 from Southern Company. And I also deposited my regular $125 every single week, and that bought SCHD. Let's see, 1.59 shares. And then I also received a dividend from Johnson & Johnson on June 7th of $5.85. And those three dividends bought me more SCHD, 0.43 shares. And then Microsoft gave me a pretty good dividend of $2.76 on June 9th. And then on June 10th, IBM gave me $11.86, and Pfizer gave me $12.54. And if we go back to my portfolio, you'll see I have the $33 in cash from those dividends. That will be going in SCHD along with my $125 that I deposit every single week. And maybe I'll receive another dividend by tomorrow morning. And as you can see here, for my overall portfolio, my market gain is $1,467.94. And I've honestly been up as much as, I want to say, 6,500. So that's quite the drop for my portfolio since the all-time highs. However, one thing that I'd like to keep in mind with my portfolio is that even though my net worth decreases, the value of my stocks decrease, what I am increasing are my share counts. That's what I'm looking at the most, and that's what's most important to me, because if I'm able to buy more shares of these dividend paying companies, I'll receive more dividends. And especially with the prices going down, that dividend yield is going to go up. It's going to increase, which is going to allow me to buy even more stocks with a higher yield, which once I receive that dividend yield, it'll buy more stocks. And that's the compounding effect. So now I want to go into the topic of this video, which I'll be reviewing Warren Buffett's top 4 highest yielding dividend stocks. And right before I go into that, I just want to say that Berkshire Hathaway is on pace to earn more than $6 billion in dividends. So that is absolutely insane. And guys, if you would love to receive $6 billion in dividends, go ahead and hit the like button. It'll push this video out to more people. And let's get started with the first stock, which is Citigroup, ticker symbol C, at a current price of $47.71. It's actually year to date down 24.39%. It's got a 6.85 EPS, and a PE of 6.97. That's pretty good. A 4.28% yield and a market cap of 97 billion. So let's go into the financials of Citigroup, and we'll come down here to their total revenue, which actually not that bad. It did go down a little bit during the pandemic, but it's starting to come back up and increase. And then if we go to their net income, it's the same story. Their net income was going down because of the pandemic, which is understandable. However, it increased in 2021, and their total future revenue they're expecting is going up. It's a little bit lower than the previous year, but they still have time to make that up. However, something that I do want to point out with Citigroup is that they actually cut their dividend in 2009 as part of the bailouts for the recession, and they did not raise their dividend in 2021. And this is one of the main reasons that I don't buy bank stocks, is because, like I said, during the Great Recession, they had to cut their dividends to receive the bailout money. And during the pandemic, a lot of them didn't increase their dividends. But we are looking at a healthy payout ratio of 24% and a 5-year growth rate of 26%, which is insane. So it does say 0 years of dividend growth. I'm not exactly sure if that's accurate, because Seeking Alpha is a little weird when it comes to the dividend growth charts. However, for me personally, I wouldn't buy Citigroup. I wouldn't buy a banking stock, but that's just me. You guys are free to make your own decisions. Next up, we have Kraft Heinz Company, which is a food company. Normally, I really like food companies. I own quite a few of them, like Pepsi, Kellogg's, General Mills, Hormel. Like, my portfolio has a lot of food stocks. However, something to keep in mind with Kraft is that they did cut their dividend in 2019, and they also had a $15.4 billion write-down. And Warren Buffett also stated that he believes Heinz paid way too much money for Kraft. Says that it was overvalued. But if we look at it, it's at $37.45. Year to date, it's actually up 3.62%. Has an EPS of 2.68, a solid PE at 13.98, and a market cap of 45.62 billion. If we look at their financials, you can see that their total revenue it was going down a little bit through the years. It actually picked up during the pandemic, because the good thing about food stocks and food companies is that during recessions, during crazy things like pandemics where people are staying home more, they buy more food from stocks like Kraft, General Mills, the box foods, the pre-prepared meals. And as you can see, their revenue is a little bit lower than 2021, but it's still at a solid pace. And if we scroll down to net income, it is really crazy. It's all over the place, and it's actually a lot lower than what it was in previous years. So that, to me, is a red flag when it comes to this stock. And if we look at the dividends, see they have a payout ratio of 56.74%. It actually says they have a negative 5-year growth rate, and that's part of the reason that they cut their dividend. Honestly, any stock that cuts their dividend is not a stock that I want to keep, because that sets a bad precedent. So even though I love food companies, this one, not for me. Now, the third highest yielding dividend stock with a yield of 5.04% is Verizon. This is actually a stock that I own, and I want to say I've been negative on this stock the whole time I've owned it. However, they do pay me a a good dividend. As you can see, 5%. Currently trading at $50.82. Year to date, they're down 3.09%, and they have EPS of 5.4, a PE of 9.41, and a market cap of 213.93 billion. Now, if we go over to their financials, the total revenue has actually been increasing. Of course, it went down during the pandemic, understandable, but looking forward, their revenue is increasing. And if we go to their net income, it's actually down from the highs of 2017, but it is starting to pick up again. And something to note about Verizon, they're spending a lot of money on their infrastructure for 5G, which would really help them boost their revenue. However, a downside to Verizon is their large debt. So if I did not own Verizon already, I probably wouldn't buy it, seeing as what happened to AT&T could happen to Verizon. But now going on to the last stock, and the highest yielding stock that Warren Buffett has is Store Capital, and they have a dividend yield at 5.84%, which is pretty crazy. And they're currently selling at $26.39, and they are down 23.73% year to date, with an FFO of 2.17, a PFFO of 12.19, and a market cap of 7.46 billion. And if we go to their financials, we can see that their total revenues have been increasing over the years, even during the pandemic. That is great to see. And you have their net income also increasing over the years, which was also great to see. Of course, it looks like net income went down a little bit during 2020, but overall it is trending upwards, which is great to see. And if we go to their dividends, they have a payout ratio over 100%, which the payout ratio is always funky with REITs. They do have a pretty decent 5-year growth rate of 5.85%. Now, Store Capital is a stock that I used to own. I ended up selling it during the pandemic. I'm not sure if they did cut their dividend, but if they still have a positive growth rate, I doubt it. And honestly, this is looking like the best stock out of the 4 in the group. I probably should have kept it. One thing I love about this REIT is that they actually do triple net leases, which are great for the company doing them, because that means they don't have to pay for insurance, maintenance, or property tax, which means they can keep more of the money for themselves and pay it out to the investors. So guys, those are the top 4 highest yielding dividend stocks from Warren Buffett's portfolio. Thank you guys for watching, and I will see you next week.